Hi, welcome to Location Keep, Weaver's Beyond the Numbers real estate podcast. I'm Howard Altschuler, audit partner in our Fort Worth office and Weaver's real estate leader. Aaron Griss, one of our tax partners and real estate tax leader, also in our Fort Worth office.
Hey, Howard. Good. How are you doing today?
Good.
Well, today joining us is Harold Bordwin. Harold is the principal and co-president of Keene Summit Capital Partners. Harold, thanks for joining us.
Hey, my pleasure. Good to see you.
And Harold, since people can tell that you're not sitting on the couch with us, where are you at?
I'm in Manhattan, New York, not Manhattan, Kansas.
Good to know.
So can you give us a little bit about your background?
Sure. Started my career as an attorney, big firm litigation in Los Angeles. 1988, had a baby, was working 18 hours a day, 7 days a week. Needed a change of pace so I could see my baby. And my father had started this business, Keene, in 1982. And I asked about coming back to work with him, and he sent me a plane ticket. And the next thing you know, I was in the real estate restructuring world. So I've been doing this since 1988.
Well, we'll have a few points going in later in the discussion about some of the stops in between. So what exactly does, Keene Summit do? You mentioned the restructuring world, but I feel like there's probably a lot more to it than just restructuring.
Yeah, we have a pretty wide range of services. Kind of the two core businesses. One is real estate disposition. We're brokers and auctioneers. And two is real estate restructuring. And each of those pieces of our business in any given year make up 40 to 50% of our revenue. And then we add into that, depending upon the year, fiduciary services. So I'm a receiver and asset manager. I've been an independent director. Investment banking, which typically involves real estate bridge loans. And that's kind of the range of services. The real estate disposition piece of the business is interesting because if you ask any real estate broker, what do? They're tying what they do to a geography and to a property type. So they might say, I do logistics in the Dallas-Fort Worth area, or I do multifamily in Los Angeles, et cetera, et cetera. And for us, that's not us. We're the opposite of that. We're really focused on kind of process and working in bankruptcies, workouts, restructurings, receivership, Article 9 sales. And where we're tied into like getting deals done in kind of hairy situations. So we work on all property types. And we do this across North America and sometimes a little bit beyond North America. So we're property type agnostic and geography agnostic. And I think that's kind of a distinguishing characteristic of our business.
Just a quick question on that, Harold. So when you're doing the work in that area, are you predominantly working for the borrower, or are you predominantly working for the lender?
So we're doing both, but predominantly it's for the borrower. So we do on the lender side for dispositions, we're selling REO property for a bank, we're selling a note or notes, or we're running an Article 9 sale process.
So you've mentioned receivership a few times. Can you kind of elaborate on what exactly receivership is for our listeners that are unfamiliar?
How can you be unfamiliar with receiverships? This is important stuff. There's a broad range of things that receivers do, but in the real estate world, in a default situation, the lender typically has the right in its documents or has a common law or statutory right to replace management and put somebody else in control of the asset. The idea being that the lender wants to preserve the asset and the concern that the borrower might be stealing money or mismanaging the property. So this is a mechanism to have the court appoint somebody as a fiduciary who actually is not a representative of the lender, but becomes a representative of the court to preserve the asset and sometimes to sell the asset.
Think about from a residential standpoint, keeps the person living in the house from ripping out the air conditioning, the copper wiring, trashing the pool,
right?
All that stuff.
Yeah, but I don't think this happens. Receivers aren't typically appointed for like a single family residence, but they are appointed if there's a multifamily property or really any kind of commercial property. Those are the instances where a lender would think about moving for the appointment of a receiver.
And you said that you're a agent of the court, so it has to be a court order to get a receiver put in place, even though the documents would allow for it.
Yeah, it's a court-ordered process, and it's state by state, and some states have some very defined rules, statutory rules about what a receiver can and can't do, and in other states, there's really very little law that's written, and basically the rules are what you get into the court order that appoints the receiver. So that court order becomes a very important document for the receiver.
Sorry, we got you a little bit off of track. You were talking about some of the other areas that y'all work in.
Yeah, I had talked about the real estate disposition side of our business. The other side is real estate restructuring, right? And those two pieces add up to 80 to 100% of our business in any given year. The real estate restructuring part, everybody thinks about that as debt restructuring, whether working on the borrower side or the lender side. And we do that. But really, what we spend most of our time on in the restructuring business is lease restructuring. So we represent tenants negotiating with their landlords for rent concessions or lease terminations. That is a big part of our business. We work across industries. Where we're most active today is in the casual dining and QSR, quick service restaurant space. But we have retail tenants. We had a lot of medical tenants who we represent, and sometimes we've done office and industrial. So that part of the business is it's pretty interesting outside of the context of a bankruptcy, where you have, let's just say, last year we represented Red Lobster. They had 650 locations around the country that we were engaged to negotiate rent concessions, and they were in Chapter 11. And when you're in Chapter 11 bankruptcy, the tenant has certain powers, among them being the right to terminate contracts. So a tenant can, it's called reject, can reject its lease and vacate the premises. And while that is considered a breach of lease, just like if it happened outside of bankruptcy, the difference is outside of bankruptcy, the landlord sues the tenant for the entire remaining rent. And presumably, if there's money, they collect it. Whereas in a bankruptcy, that claim is a capped claim under a formula, never can exceed 3 years' rent. And then when it gets paid, it gets paid pari passu with other unsecured creditors. So in a typical bankruptcy, unsecured creditors are getting, 3, 4, 5 cents on the dollar. So for a landlord, it's kind of a wipeout. So if we've got a tenant who's in Chapter 11, and we're negotiating with a landlord, our negotiating posture is, look, we need an X% rent reduction, or else we're going to reject this lease. And you'll be stuck with a vacancy and all of the costs associated with having vacant space and then re-renting it.
Isn't that what happened with like WeWorks when they did their bankruptcy? Is they rejected a whole lot of the leases that were out there?
Yeah, absolutely. It's very powerful. And those landlords end up getting left with very little.
And I guess you guys must have been, I'm just thinking I had a client back in, right after the pandemic that was retail, and they had, there were rent concessions left and right at that point because, the stores were closed, the tenants couldn't pay the bills. And I'm presuming you guys were pretty busy around then when all that was going on.
Oh, God. Yeah. I mean, I think back to that. So like February of 2020, we started getting some calls from retailers. March of 2020, we're on the phone all day with retailers, but nobody's hiring us. And I think it was because nobody could really figure out, if you think back to those days, like, when is the world going to reopen? And at the end of the March, like all of these conversations we had with retailers turned into engagements. And 2020 was just an insanely busy year. and it continued into 21.
And I don't know how it worked out with most of your clients that were doing that. At least with the case of my client, at the end of the day, it all worked out okay. They gave a bunch of concessions, but I guess they had a strong property to begin with some strong tenants, because when it was all said and done, they were kind of made whole. They were able to, get the payments paid later. They were able to extend the leases a little bit. So um, it didn't turn out to be a bad thing for them, but I know that's probably more the exception than the rule.
Yeah, I think that's more of the exception. And I think there probably are a lot of examples where everyone rationally recognized that, the stores are closed and there's nobody who's showing up to shop. And we have to figure out how to, get you off the hook today, but you're going to make it up later. But, our clients typically making it up later is not an issue. It's that the locations themselves, the economics of those locations, and let's put 2020, 2021 aside. In this day and age, there are simply locations where the world has changed and the economics don't work. And in some instances, the landlords think that their location is good and don't mind getting back the space and are happy to get back the space sometimes. And in that instance, like, we don't have any negotiated leverage, and our client typically doesn't want the space if they're not getting a concession. So we hand back the space. But in other instances, the landlords don't want to deal with the costs and risks of a vacancy. And that happens mostly, there's a big difference between, we'll say mom and pop landlords and institutional landlords. And the institutional landlords are a little bit more accustomed to dealing with vacancies and have a bigger portfolio that can balance out the cash flow. It wasn't unusual, like in the Red Lobster scenario, that the landlords were retirees and were counting on that rent as a source of income in their retirement. So that's a more challenging situation, but they they care much more about allowing a space to go vacant.
No, I get that. And I guess the other part too with the institutions is they're also a lot less emotional about things.
Yeah. So they say no. That's what they say at first. No, 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 no. Yeah, we're usually pretty good at breaking through that because at the end of the day, the economics, like, we're not threatening something that's crazy. We're able to show them that, look, this location doesn't work, and if you're not going to work with us, then you're going to get back a vacant store. You want to have this tenant, then you got to work with us. I guess the more interesting scenario is outside of Chapter 11, and a lot of our work is for companies that are financially challenged and they're trying to stay out of bankruptcy and they need rent concessions or lease terminations on bad locations to stay out of bankruptcy. And there, like, we don't have the immediate cudgel of rejecting the lease in a bankruptcy. So first, we've got to convince the landlord of the seriousness of the risk of default. And if the default happens, you'll be in bankruptcy, and you don't want that to happen because bad things happen to landlords in Chapter 11. So it's kind of a two-step process.
So as let's say I was a landlord, what from your perspective is representing the tenants, kind of what's a good course of action for a landlord to help this get resolved smoothly or as smoothly as possible?
Oh, the easy answer is just say yes.
Well, right. Yes, yeah, from your perspective, that's the easy answer, but I'm sure that's not quite the way it usually works.
So sometimes it does, actually. But look, the landlord has to. We say this to our clients ahead of time, and I say this to the landlords too. If I'm negotiating with a landlord, I say, look, this is not a great call. You'd rather take just about any other call than a call from someone like me who's asking you to terminate a lease and get a teeny payment in return for it, or to give the tenant a rent reduction. Like, you're a landlord, your job is to collect rent, and you want to collect more rent and more rent. And you've got bills to pay, and you've got maybe partners who are expecting payouts. Um, but at the end of the day, you got to make a decision about, like, what's the best decision for you. And if, like, you're in a great shopping center and there's no other vacancies and the location I'm calling about is a location that you think you could fill up at my rent or better, then you're going to tell me to take a hike. And that, like, I totally get that. And if it's not that, if it's somewhere at the other end of the spectrum, then you ought to work with me sooner rather than later.
I guess it's just both parties need to be realistic about it. But
And it also seems like there's also a case to be made as a landlord for doing good due diligence on your tenants.
You might have done good due diligence, 10 years ago. Like, markets change. There's only so much you can do.
Sorry, we put you on the tangent again, so let's keep going. Any other areas you wanted to focus on from what King Summit does?
Yeah, so those are really the core pieces of our business. And as I said, we kind of like fill in with related projects. One of them being real estate investment banking, mortgage brokerage. And in that instance, the typical scenario is we get a phone call from an attorney and they say, literally, this happens all the time. We have a deal that just fell through. It needs to close in 3 weeks. And we need $30 million. We'll give a first mortgage for that. And, can you help us? And the answer is actually yes, because we've got a great Rolodex of people who do that. And we've got a pretty good track record of, in the course of, 2 weeks, getting a bunch of term sheets and being able to get a deal closed.
some of the first partners I worked with when I was yelling when I first started my career 14 years ago still around next to me, but it's been a while.
That's funny that I used that phrase. But I used to literally have, I mean, it's probably 8 or 9 years ago, where my secretary said, I mean, she was keeping, I probably had 10 Rolodexes, right? I'd get business cards and I'd give them to her and she would staple it in alphabetically. She'd put it in our database too. And can't recall ever looking back at a Rolodex. And she's like, we're moving offices. And she said, Harold, time to throw these out. And it was very painful, but we did.
But you know what the funny thing is, though, is when you had them all in the business card holder or the Rolodex, you could find it. Now it's at your fingertips in Outlook, and you just cannot find that contact when you need it.
Yes, that happens all the time, and people disappear somehow. So in terms of that Rolodex, it's a terrific Rolodex for finding a kind of emergency bridge loans. Two is stepping into fiduciary positions. So um, it could be stepping in as a receiver, as I talked about. Um, the instance where I was an independent director was an interesting situation. It was a hotel in Chapter 11 bankruptcy, and the time had come to run a bankruptcy sale process. And the principal was intending to bid at that sale. And the debtors' counsel and the lenders' counsel basically recognized that the principal couldn't be both a bidder and the decision maker as to who's the winning bidder. They brought me in as a director to oversee the sale process and deal with a whole bunch of issues that came up at the end of the project. But that was an interesting scenario, and I'm open to doing some more of those things. And then this last project is an asset management project, and the scenario is six community banks. Six community banks foreclosed on a 380,000 square foot, 18 building office tech R&D park in upstate New York. And as the foreclosure was coming to a head, the bank's counsel said, well, you're about to be the owner of these 18 buildings. And, every day as an owner, issues come up, questions arise, tenants have to talk about something. Who amongst you is going to take the lead on this? And I think they went kind of like this. And so the attorney suggested they hire an asset manager. And it's a job I've never done before, but it's hugely fun and fascinating because literally every day something comes up and I'm learning things that I didn't know before. But as a real estate person, it's a lot of common sense about how do you maximize value, how do you treat your tenants with respect, and at the same time not get taken advantage by them. and, where do you spend money and where do you conserve money? So all really, really interesting to be kind of on the principal side of an active project.
So, if karma's anything, at some point during this asset manager role, you're going to get a call from your tenant saying, I want a lease reduction. What do you do then?
I will evaluate the situation. I'll do a lot of due diligence. What's interesting is in this park, as I said, it's R&D and a lot of R&D tenants, and it's a lot of tenants who are kind of spun out. The grad students coming out of Cornell, and they're getting kind of venture capital. And one of the issues that we've been dealing with is a variety of these tenants during prior to the foreclosure. Um, Defaulted on their leases. They ran out of funding and kind of left. And now we have to deal with various kinds of kind of high tech equipment. We've got labs that have been vacant for months, but we've got biological specimens in freezers, and we have to like, yeah, yeah, yeah. I told my property manager, we're paying all this electricity. Unplug all to everything and let's save energy. He's like, we've got biological specimens in those freezers. Oh, never learned about that before. So every day there's something new.
If we hear about a pandemic escaping from upstate New York,
I don't think it's that kind of biological.
So are is all the biological specimens and these RD equipment that was left over, is that property of the entity that owns that building now?
So that's really this turned into a big issue because the leases of those tenants were not clear that if they default and vacate the premises, they abandon the equipment to the landlord. And New York State law is not really good on this topic. And so we're working to try to get some of these tenants to formally abandon it to us. Um, some of the tenants we can't locate. Um, Others we're having a hard time just getting to a deal. So what the process is you call in a moving and storage company, and you have them pack everything up, and you send it off to a self storage facility, and you pay for 1 month's rent, and you notify the former tenant and any secured creditors that their equipment, their collateral is sitting in self storage here. We've paid for rent through the end of the month. And after that, you know, either you pick up the rent, pick up what's in the locker.
yeah, because I guess my gut would have been it's kind of once the tenant abandoned the space, it's your property now. But I guess given the fact that you've got equipment, that's one thing, but having biological stuff, that could be a liability more so than an asset. You never know.
Yeah, I mean we've got biological specimens, we've got chemicals, we've got sharps. So all of that's got to be dealt with. Sharps, needles.
Well, I thought you said sharks as in, swimming in the ocean, a shark cloning company. You never know. So let's go back a couple of things from the past. You mentioned you started as an attorney, and I think you were in California. And I understand, and I believe more of a native New Yorker. So what was the culture shock, or what was it like being in California as a young attorney?
So given that this is available to people on both coasts as well as in the center of the country. In truth, I loved it. We were in Los Angeles, and my new wife and I were both working. And as far as we could tell, this is 1985. I think my salary was like $17,000 a year, and hers was 15,000, and that was more money than we could ever imagine. We were just like living large. Um, and she grew up in Los Angeles. For me, you wake up every morning and it's 70 degrees and it goes up to 80, and you could go to the beach, in 20 minutes from where we lived. It was lovely. It was really a nice life.
Okay, but
The but didn't have to do with California. The but had to do with what we now call work-life balance. And I was a litigation associate at two different very large firms. And I was working, as I said, I was literally working 18 hours a day. 7 days a week. And, I'd be there on Saturday and Sunday, and the partners were there too in the litigation department, looking around and thinking, like, this isn't such a great future. I might be willing to do this, for a few years to earn my stripes. But this litigation thing it doesn't get any better as you get more senior. But I loved being a lawyer, intellectually really challenging. I liked the clients. I loved being in court, but I was working 18 hours a day, 7 days a week. And as a litigator, this is like my father always told me to be a lawyer because you can always do other things. And I couldn't quite figure out what other things I could do with the skills of being a litigator. So that was the impetus for picking up the phone and calling him and joining him in the business he created.
Okay. Well, I was told to be an accountant, then you can always do other things. And hell, I'm still an accountant. So go figure. But it is funny you mentioned, the work-life balance. You said that was like 85, 80, 84, 85. I started working in 89, and the words work, life, and balance were never spoken in the same sentence. That didn't exist back then. I remember I didn't work quite the hours you did, but I worked a lot of hours. But I remember seeing the partners at the CPA firm, and they looked like they had it cush because I never saw them. They'd show up to the client for a couple of hours, then they'd go back and, play golf or whatever they were doing that didn't seem to be working. And I'm like, yeah, I want to be a partner one day. They have an easy life. And I don't know if either they hit it really well or something changed between then and now because I don't feel like I'm working less than my team is.
Yeah, but I don't think CPAs are working as much as they did back in the day.
No, at least not from, not from when I started.
Yeah.
For whatever reason, I ended up as a litigator. If I had been a real estate attorney, maybe I would have gone into real estate. Maybe I would have joined a real estate company at that point. Or if I had been doing more general corporate law, maybe I would have moved in-house to be a corporate attorney, in-house corporate attorney. So you never know how these things play out. And I count myself lucky that I had a father who was in a business that he was able to bring me in.
And I guess also lucky that I'm assuming you liked working with your father. That would have been a non-starter in my case as well.
So Harold, we've been talking real estate now for a while. What is your prediction? And this is like a question we ask most of our guests. What's your prediction for the real estate market next year, and specifically in the space that you play in? Is it better for you if it's doom and gloom?
So I'll say this. Let me touch on your last question first. Like, I don't wish gloom and doom upon anybody. And we're busy in good times and in bad times, because there's always businesses that are in some sort of restructuring, and there's always perpetrators of fraud. So there's always work for us to do, and I don't wish doom and gloom on anyone, truly. And when things get really doomy, like at the point in a recession where capital has dried up, that turns out to be really bad for a real estate brokerage business because buyers aren't buying. Right, everybody's sitting on the sidelines looking for capital. Going back to the big question, what's going to happen in 2026? If we all had a crystal ball, we wouldn't be here. But here's what I think. What's been happening in 2025, I think is going to continue, and I think market conditions are actually going to get worse. And here's why. And when I say what's happened in 2025 will continue, in part what I mean is, an important thing happened when interest rates rose in 2022, right? Interest rates rose, and coming out of COVID, all of the supply chain issues and inflation, and that had a dramatic impact on value. Interest rates went up, value went down, and as debt matured, people with mortgages that they took out that were fixed rate at 3%, they'd have to refinance it, and they were financed like 80% loan to value, but now values have come down 20% plus or minus, and lenders are more conservative, and you're never going to pay off that loan through refinancing. I mean, you have to cough up a lot of capital, and is it worth it or not? So that's what we've been seeing a lot of over the past 2 years. We've been seeing borrowers who are over leveraged in light of the fact that property values have come down and interest rates have gone up, and they can't afford to refinance. That's been that's been a huge trend, and I expect that to continue. What I think is really interesting, and I think it's counterintuitive, is this administration is pushing for the Fed to lower interest rates. And that's a big piece of the political pressure on the Federal Reserve. And they're going to get the Trump administration is going to get to appoint a new Fed chairman come midpoint of 2026. And so what happens if the Fed actually succumbs to that pressure to reduce the Fed funds rate? The Fed funds rate is a very short term rate. It's the most short term rate that there is, and it's not a rate that really impacts real estate lending. Right, real estate lending is largely tied to the 10-year Treasury bond, and so what's going to happen to the 10-year Treasury bond? We're in a state today where inflation has not been resolved. Inflation remains an issue. And if the Fed lowers rates, the impact on inflation is likely to be increased inflation. And if inflation goes up, then long-term Treasury rates are going to go up to account for that. So there seems to be a lot of press, articles in the real estate press and talk amongst real estate people that they really want the Fed to lower interest rates. And I don't get it. I think the interest rates are going to come down somewhat. We'll probably get the talking heads think we'll get a 25 basis point reduction in the Fed funds rate in December. That's next week, I guess, and maybe one or two more of those in the first half of 2026. But I just see that as a bad thing for the real estate world. I don't get it. I don't know. Do you have a different thought about that? I'm turning the tables here on you.
I'm totally in agreement with you on that. It's my wife is a mortgage lender, residential mortgage lender, and she keeps going, I'm just gonna wait, tell my clients to refi, rates are gonna go down, rates are gonna go down. And I keep telling her, are you sure? And she doesn't want to hear it, obviously. But I'm with you on that. I've heard enough people say that, just because the Fed starts lowering rates doesn't mean that the long-term rates are going to go down. And you're right. That's what's driving the real estate market and the lending market is the 10-year rate. And, if you start to get to a point where people start to lose confidence in the process and lose confidence in the integrity of the Fed, then nothing good's going to come out of that.
Yeah, nothing good's going to come out of that. So we shall see. I mean, for the most part, these things happen slowly. They don't just like hit by the same token. People have been predicting, recessions. People always worry about what is the next black swan event. And you can't, because it's a black swan event, you can't guess today what it is. But we've got this weird economy. We'll call it a K-shaped economy, and people use that to talk about the consumer because the high-income consumer is doing well and is spending, whereas the lower income consumers are not. I think that's the same in like the real estate market, right? You've got pieces of the real estate market that are performing well, but there's a whole bunch of the real estate market that's not. And this this refinancing risk, I think, is really significant. I think it's not just significant to borrowers, but I think it's significant to community and regional banks. And that was a lot of that was talked about and speculated about. And Those concerns were raised at the time that Silicon Valley Bank and I forgot the other bank, Signature maybe, both went down. Maybe that was March of 23. I don't recall precisely. Um, Sounds about right. But those issues of, having 3% mortgages that can't be refinanced and the owners losing equity in property, that's an issue on the lender side as well. And there are going to be a bunch of financial institutions that are, I think, going to be taking significant hits, just like the Silicon Valley banks did when they owned what they thought was the safest thing in the world, which were treasury bills.
And worse than the banks is also going to be all the non-bank lenders out there who, been doing a whole lot of stuff totally unregulated. And, there's kind of no telling what worms you're going to find when you turn over some of those stones.
Yeah. So you've got these non-bank lenders. Um, and what I'm confident is not being recognized. Well, we don't know precisely who they've lent to and on what terms and what's happening with those loans. But where are they getting money? They're leveraging, they probably have lines of credit, warehouse lines from the banks, right? So everything is interconnected. And those warehouse lines are at risk.
And when it's all said and done, the three of us and another 300 million Americans will pay for it, potentially. So much for no doom and gloom.
Yeah.
But, good news doesn't sell, right?
Yeah. Good news makes you happy at the end of the day. But I mean, I think we're in a serious situation. The Fed independence issue has broad implications. The consensus is that the Fed funds rate is going to go down, and there's no doubt that inflation is still out there. There's no doubt that it hasn't been whipped. So it's a problem.
All right. Well, thanks for joining us today, Harold. We really appreciate the conversation.
Thank you so much for having me. This is it's been fun to talk about these things.
Yeah, I agree. I had a great time talking, so appreciate you joining us. So that's going to wrap up this episode of Location Cubed, Weaver's Beyond the Numbers Real Estate Podcast. You can catch all of our podcasts on Apple and Spotify and the Weaver website. Thanks for watching.